What if I told you that your job, your savings, and your future are all tied to a single number? A number so vast it defies imagination, quietly ticking away in the background of the global economy, like a financial doomsday clock. Most people have never heard of it, yet it dictates the fate of everything we know. This isn't a conspiracy theory, it's a mathematical reality, and that clock is closer to midnight than ever before. We are talking about a $600 trillion shadow system, an invisible architecture of finance so large that it makes the entire world's economy look like a child-ass toy. And the people who built it are starting to lose control. To understand this, you have to forget everything you think you know about money. This isn't about owning stocks, bonds, or real estate. This is about something far more abstract and infinitely more dangerous. It's called the derivatives market. A derivative is essentially a bet. It's a financial contract that gets its value from something else. The price of oil, the movement of a currency, or the interest rate set by the government. It's not the asset itself. It's a wager on where that asset is headed. In the simplest terms, it's like placing a bet that your neighbor's house will burn down. You don't own the house, but if it goes up in flames, you get a massive payout. Now, some of this is legitimate. An airline might use a derivative to lock in fuel prices to avoid sudden spikes. A farmer might use one to guarantee a price for his crops, but that's a tiny fraction of the market. The other 99%, the part that makes up that staggering $600 trillion figure, is pure, high-stakes speculation by the world's biggest banks, all built on leverage. But to truly grasp the danger we face today, we have to look at the last time this system shattered. The year was 2008. The crisis didn't start with derivatives. It started with bad mortgages. But those mortgages alone weren't enough to bring the world to its knees. The real weapon of mass destruction was the layer of derivatives that banks had secretly built on top of them. They created contracts called credit default swaps, which were essentially bets on whether people would default on their homes. When the housing market cracked, these bets turned toxic. Investment bank Lehman Brothers, which appeared solvent on the surface, had a hidden exposure of over $35 trillion in derivatives. When its bets went bad, it didn't just stumble. It evaporated overnight. Suddenly, every bank connected to Lehman was facing catastrophic losses. AIG, the insurance giant, owed more money on its derivative bets than the company was worth. The entire global financial system froze. For 72 hours, it was unclear if ATMs would work, if credit cards would be accepted, or if the world economy would simply stop. The system was saved only by the largest bailout in human history. But the most shocking part of the 2008 crisis isn't what happened. It's what happened next. We were told that the system would be fixed. We were promised that too big to fail was a thing of the past. It was a lie. Instead of dismantling the doomsday machine, they supercharged it. The same banks that were bailed out with taxpayer money went right back to the casino, but this time with even more chips. The regulations that were passed were little more than window dressing. They tinkered around the edges but left the core structure of the system not just intact, but stronger. In 2008, the derivatives market that nearly ended the world was valued at around $60 trillion. Today, that number has exploded to over $600 trillion. The problem wasn't solved. It was magnified by 10. The banks that were too big to fail are now colossally larger. Their fates more deeply intertwined than ever before. For over a decade, this monstrous system lay dormant, fueled by near-zero interest rates and the illusion of stability. But then, the first cracks began to show. The first major tremor came in March of 2021, and it didn't come from a bank, but from a single, secretive family office called Archegos Capital Management. Its founder, a man named Bill Hwang, had used complex derivatives to make gargantuan, leveraged bets on a handful of stocks. Because he was using derivatives, he never had to disclose his positions. He was invisible. He built up a portfolio worth over $100 billion using just a fraction of that in collateral. But when one of his stocks dipped, the house of cards came crashing down. The banks that had lent him the money demanded their collateral, which he didn't have. In the span of just a few days, Archegos imploded, leaving its lenders with over $10 billion in losses and sending shockwaves through the market. One man, operating in the shadows, had nearly broken some of the biggest names in finance. Then, just a year later, the danger came for everyone's retirement. In the fall of 2022, the Bank of England was forced into an emergency intervention to stop the complete collapse of the UK Dwarf pension funds. These funds, which managed the retirement savings of millions, had used derivatives to hedge against interest rate changes. But when rates moved too far, too fast, they were hit with margin calls so massive they were on the brink of insolvency. The central bank had to step in and print money to prevent a systemic meltdown. These weren't hypothetical risks anymore. These were real-world failures proving that the system was a hair trigger away from disaster. But these events were just tremors. The real earthquakes are still building along three major fault lines. The first ticking time bomb is the interest rate trap. For over a decade, central banks kept interest rates at or near zero. This created a long period of artificial calm, allowing banks to build up mountains of derivative positions that assumed stability would last forever. But starting in 2022, that calm shattered. To fight runaway inflation, the Federal Reserve hiked interest rates at the fastest pace in 40 years. Every single derivative tied to interest rates, which accounts for over 500 trillion of the market, was suddenly exposed to violent swings. Right now, banks are sitting on colossal unrealized losses from these positions. Thanks to convenient accounting rules, they don't have to admit it yet. But the losses are there, festering just beneath the surface, waiting for a catalyst to make them real. The second time bomb is the commercial real estate doom loop. All across the world, office buildings sit empty. The value of these properties is plummeting. The problem is, these buildings were financed with loans that are now coming due, and they must be refinanced at much higher interest rates. The income from these buildings can no longer cover the debt payments. This is already causing defaults, which puts immense pressure on the regional banks that hold those loans. But the real danger lies in the credit derivatives tied to that corporate debt. As defaults mount, these derivatives will trigger massive payouts, creating an AIG-style problem on a scale we've never seen before. The third time bomb is the brewing currency war. For decades, the world has run on the US dollar. But that dominance is now being challenged. Nations like China, Russia, and the BRICS alliance are actively moving away from the dollar, settling trade in their own currencies. If this de-dollarization trend accelerates, it could trigger unprecedented volatility in currency markets. There were $100 trillion in currency derivatives, which are all bets on exchange rate stability, would become a minefield. A sudden shift in the dollar's value wouldn't just cause losses, it would call into question the very foundation of the global financial system. And at the epicenter of all of these tremors stand four institutions. In the United States, the overwhelming majority of derivative risk is concentrated in just four names: JP Morgan Chase, Citigroup, Goldman Sachs, and Bank of America. They have become the four horsemen of the financial apocalypse. The numbers are so extreme they sound like typos. JP Morgan holds over $55 trillion in derivative exposure. Citigroup holds over $45 trillion. The derivative books are not just larger than their assets. They are dozens, even hundreds of times larger than the capital they hold in reserve to cover losses. These four institutions are linked to each other and to every other major bank in the world through a tangled web of contracts. This is known as counterparty risk. On paper, their positions might look hedged, but those hedges only work if the entity on the other side of the trade can pay. It's a circular firing squad. The moment one of them fails to meet its obligations, the hedges of every other bank evaporate. The collapse of one doesn't just damage the others, it guarantees their destruction. This is what turns one failure into a systemic contagion, which leads to the one question that no one in power wants to answer. Why can't they just bail them out again? If the system starts to break, won't the government just step in like they did in 2008? The answer is a terrifying no. The math no longer works. The 2008 rescue, including all the bailouts, liquidity programs, and guarantees, cost an estimated $29 trillion globally. That was to save a derivatives market worth around $60 trillion. Today the market is $600 trillion. If just 5% of today's market fails, that's $30 trillion in immediate losses, more than the entire 2008 rescue package. And that's just the first wave. No government on earth has the capacity to fund a bailout of that magnitude. The United States is already over $34 trillion in debt. European nations are in a similar position. The only tool left would be to print money on an unprecedented scale. But printing tens of trillions of dollars doesn't solve the problem. It destroys the currency. Even more importantly, there is no political will for another rescue. In 2008, the public was scared and confused. Today, they are angry.